Good afternoon, everyone. My name is Todd Barrett. I am a loan officer here with Fairway Independent Mortgage. Today is September 26, 2018, and we just had some big news come out here this afternoon. Jerome Powell and the Federal Reserve have decided to raise the federal interest rate up 0.25%. They're now between 2 and 2.5%. And so I've got a few questions on this here just today on basically what does this mean for you as the consumer on just general products you use every day, such as a credit card, as well as mortgage products. So wanted to make a quick video here, see if I can answer that for you. What essentially has happened here today is Jerome Powell and the Federal Reserve met, and during their meeting they talked about the economy and basically, in short, how well the economy has been doing. Unemployment's at an all-time high. They're seeing inflation now at an estimated 3.1%. And so basically, in short, the economy is humming along and it's growing pretty quick. And the Federal Reserve needs to raise the key interest rate here up to basically slow down that inflation and keep the economy from running away. So what the Fed rate is actually the rate that the Federal Reserve or the government lends banks to lend to you, the end consumer. And so it's what the banks pay the government for the funds that they're borrowing from them. And the history behind this is back in 2007, beginning of 2008, before everything crashed, the Federal Reserve was lending their funds out at between 5 and 5.25% to the banks. And when everything crashed in 2008, in order to essentially save the economy, they went ahead and lowered the Fed rate down to basically zero. It was between 0 and 0.25%, and they kept it there until 2016. And that was one of the ways that the government helped in the recession and trying to get everyone to get back on their feet and get the economy going again. Once things did pick up and start growing, they have decided that as inflation grows and as the economy picks up, they need to go ahead and raise this rate back up. But they can't just do that overnight. It is a slow process. So since 2016, they have raised it 0.25% 8 times. The last one was 3 months ago. And this is the 8th one here today, like I said, at up to 2.25%. And so what that means for you as an end consumer, biggest thing you're going to see here overnight is your credit card rate is going to go up by 0.25%. It is directly tied to this Fed rate, and so you'll probably be getting an email or a letter from your bank here stating that your credit card rate has in fact gone up by 0.25%. Another thing that's going to be directly affected there is going to be a home equity line of credit. Those are variable rate products, and so they're going to adjust accordingly as well. And then auto loans, if you're getting a new auto loan, you'll likely see those rates go up here. One thing to keep in mind, if you're in a fixed loan product right now, it's fixed. It's for the life of the loan. So if you have a 5-year auto loan, a 30-year fixed mortgage, those don't just adjust. Those stay the same from when you close. So don't worry about that going up. One thing that is going to go up here are adjustable rate mortgages on the terms that you have on those. They when they do make that adjustment, they're going to take into effect these higher rates. So something to keep in mind, if you're in an adjustable rate mortgage, it may be time to start looking at transferring over refinancing into a fixed rate, either 15-year or 30-year fixed, so that you can take advantage of those rates, because it does seem like these are going to continue to go up here as the economy increases. Most of the sentiment that I've read is basically saying the Federal Reserve is going to continue to raise these rates up at least 0.25%, potentially at least do it one more time this year, several of them next year, as we are still at historic lows overall. So as these rates keep going up, we're still historically low. They're not anywhere near where they were here 10 years ago or 15 years ago. So they're going to continue to go up as the economy continues, and that's something to keep in mind. If you are out shopping for homes, the typical 30-year fixed or 15-year fixed mortgages are on their way up, but they are not, however, directly tied to this rate increase. So we're not going to see a 0.25% jump in the 30-year fixed rates here overnight or even over the next week, most likely. They are tied to treasury bonds, typically the 10-year treasury bond. And so, they fluctuate based on the market. But as rates go up here, interest rates are going to continue to climb. So if it is something that you're out there and shopping around for a house, something to keep in mind, the rates are going to continue to go up, and it may be a good time to start looking here this winter. If you have any questions, please feel free to reach out to me. Happy to answer anything I can for you. All my information is down here in the left-hand corner. Talk to you soon. Thank you.